All right, welcome back to another episode of Exploring the Process. This week we've got a special guest, Dibsey, as many of you know him on Twitter. He's got a great little Mario Doctor avatar, which unfortunately we couldn't figure out how to load up, but not a big deal. Chris was kind of tied up with family stuff, so it's myself and Dibsey. We're going to go through a bunch of kind of how he leverages the process, how he discovered Hedgeye. He works for a family office, and how it's kind of he uses it in the day job as well as his own personal portfolio allocations, et cetera, et cetera. So very excited to have Dibsey on. Thank you again for taking the time to speak with us, Dibsey. Appreciate it.
Yeah, absolutely. I'm looking forward to the conversation.
Awesome. So yes, I mean, if we just kind of maybe dive into it, about your background with Hedgeye, how you discovered it, or if it was through work, and then we can kind of go from there.
Yeah, definitely. Happy to speak towards that.
Awesome.
So I'd say my background, I've, worked within the financial markets, within investing for, 6 years now, 5, 6, 7 years, something like that, depending on when you start the clock. So it's actually funny. I was aware of Keith's Twitter, dating back a couple of years ago, but it was so much on the peripheral that I didn't even know what he was talking about. I would just see it on occasion. He had a lot of followers, so I follow him on Twitter, which is a great source for market moving information.
Absolutely. Yeah.
So I knew of who he was, and I really didn't think much of, the firm, the process, et cetera, because I didn't know anything about it or the way of how risk is thought of. Fast forward up to the end of 2019, start of 2020, a work colleague of mine. So I work at a family office of sorts. So we essentially, serve as the investment arm for some very ultra high net worth type clients. So we get a really broad, variety of things that we're looking at. We'll look at stocks. We'll look at private credit. We'll look at alternative investments. We're looking, all over the place at things. So one of my colleagues, he recommended, hey, I've been watching the Macro Show. It's a really, macro, that's great. That's holistic. That's, exactly what we do. We're asset allocators. We're, putting capital where we think we're going to earn a fair rate of return, and hopefully doing well by our investors, by our clients. So that's the genesis of where we started to use Hedgeye, or where I became familiar with it. So that was back in the end of 2019, start of 2020. It's always fun to watch Keith and Jonesy Buds go at it. Very interesting personalities and characters for sure.
Absolutely.
But what I loved about it was just, the data intensive nature of it. I think in my previous background, prior to joining the family office, I was at an event-driven trading place. And it was just drilled into our heads, like whatever emotions you have, whatever biases you have, just leave them at the door. The only thing that matters are the facts and the numbers. And so the Hedgeye, risk management, macro process, et cetera, really resonated with me because, you can always spin a narrative or like make, some parts of things more behavioral, et cetera. But when it comes to the crux of things, what matters is the data and what the process, in this example is telling you. And so I thought that was great. The more and more I learned about it, I just, came to really appreciate the process. It was very holistic. It made a lot of sense. And it took the human element out of things. So I think the way that Keith marries, what the process is telling him with what the analysts are saying, from a money management perspective, I think that's absolutely the right way to go about things. I'm happy to speak towards, how that view has evolved and changed over time, but that's really a background of how we became familiar with Hedgeye, with the Macro Show, and since then, we've started to use more and more of their products. I would say it's more so the Macro Show as the crux of it, though. What we care most about from the allocator's perspective is, what quad are we in, what quad are we going to, and are we positioned appropriately? Do we need to be making any changes?
Right. And so in terms of those kind of pivots, I mean, I'm assuming, those are definitely more full investing cycle type, asset allocations that you're leveraging, right? So, from a pivot standpoint, do you have a runway? I mean, in terms of when you kind of need to either inform your asset allocators, right? Or like if you guys use anything, if you use anybody outside of kind of like, or That's what I'm looking for. Yeah. So like, outside of your kind of in-house investment committee and stuff like that. So
Yeah, definitely.
what does that kind of look like in terms of kind of, longer term, longer
Mhm.
term high net worth, I'm sure tax gains and stuff like that,
Yeah, all of
capital
those things
budgets,
are
all of that
baked in.
stuff's
Yeah.
very, is all factoring in. Right. So yeah, maybe
Mhm.
just, yeah. What does that look like?
Absolutely. So I think it really depends. So the way that we're structured, we're a multifamily office, meaning
Mm-hmm.
it's not just one or two families, it's a handful of families. Uh, so of course, each family has their own, unique background, wants and needs, risk profile,
Yep.
liquidity, all of those things.
Yep.
So when we're looking at these decisions, we're taking them in tandem with how's family A positioned. Uh,
Okay.
you know, I think right now, quad four, we just came from a roaring hot market that was led by tech for the last couple of years, and especially 2020 and 2021. Seems that that's not really the place to be anymore. So we're cognizant that yes, we have a tech overweight, for example. How we access that really depends also. Um,
Okay.
to know just in general, okay, we're overweight tech. This is what's coming next, whether it's in the first quarter and the second quarter. We know sometime during 2022 things are probably going to get shaky. It
Mm-hmm.
appeared to come a bit faster than we had expected, given the reaction in the market when FOMC minutes came out in January that they were contemplating a hike, when it didn't sound like that's what Powell was saying at all in December. But we were able to kind of sidestep that a bit. What that ultimately looks like, it really depends, which is kind of a frustrating thing.
Yeah.
You'll find here, like it always depends on how the clients are structured. It depends where their assets are. Ideally we can be tactical in the IRAs because there's no tax friction, if you
Implications.
will, when
Right.
things
Yep.
like that are sold. So ideally we do stuff there. Otherwise, taxes, as Keith has said, it's a high class problem. It's a good
Of
problem to
course.
have, that you're
Of
going
course.
for.
But in terms of hedging, then though, Dibsy, like if you're trying to short a market, will you just typically
Yeah.
use options then, or like how do you
Mhm.
guys incorporate again? Just especially majority of assets are in retirement accounts like that. Obviously, it's
Mhm.
challenging.
Mhm. Yeah. So in terms of client allocation, that's one thing, and then the personal account is of course another.
Yeah, yeah,
I would
yeah.
say
There's
that
definitely more. There's definitely more. Maybe not more rules, but there's certainly a little bit. You don't have quite the flexibility, right, between how I
yes.
handle my retirement account versus how you're kind of handling it. But for
Mhm.
high net
Yeah.
worth families with investment policies and all sorts of different other compliance related situation.
Mhm.
Yeah, situations on there.
Yeah. So to finish that thought, the way that we would think about things, the way that I would think about this is, if I want to dial down my equity risk, it's not really a question of am I going to be in stocks or am I going to be in cash, right? It can't
Mm.
be so binary like that. It's more so, what types of equity exposures will I be owning? So I think a great example is going from, tech into something more defensive like utilities or staples. You're still
Sure.
invested in equities, and to be sure, equities go up over time on
Mm-hmm.
average, and
Mm-hmm.
we're not making a call that that's not going to be the case going forward. We're just trying to be able to handle the market's volatility, et cetera, until we're
Right.
constructive on risk again. Once we're back in quad two, quad one, what have you, with whatever's left over, which to be sure it'll still be good because we're managing risk and positioning defensively. We'll be able to take advantage of that once we get to the other side. But it's really a game of going through the sequence of events and
Okay.
managing the risk throughout that, so that when it is the stars are aligning again for a good quad two, which honestly might even just be a result of things being things having gone down too much or things having slowed down too much, and as we're probably expecting, the Fed causing a policy error potentially,
Mm-hmm.
I guess. That's where a lot of opportunity can come. So I think that the big takeaway is, like, you want to be invested, you want to be you want to be there, and you want to be able to survive and stay in the market, because over time the market does go up. So
Yeah.
that's wearing the asset allocator hat. We will tweak things. So maybe like you have like a 65% equity exposure, 35% bonds, but you have a bandwidth of plus or minus 10%. Yeah, we'll
Mm-hmm.
tweak things there. But it wouldn't be like, okay, we're just going to get rid of all of our equities because we're
Mm-hmm.
not optimistic of how the future looks right now.
Right, right. So it's really leveraging. So I mean, that must be a huge, like, shift, even just like mentally, right? From
Oh
finding
yeah.
or like using Hedgeye, right? In terms of, the picture, or like the roadmap becomes a lot more clear when it's just data driven. And, again, I mean, certainly for myself, before I found Hedgeye about the same time, right? So like early 2020, and, it would have been reading headlines. I mean, today is a great example, right? It would have been Russia everywhere, war, how do you prepare for it? What's going to happen? And at the end of the day, the market's either going to price it in pretty quickly, or it's already, it's kind of, perhaps even already priced. Again, it's just like, there's so much more beyond just like the headline and the macro tourists, right? I mean, for me personally, I was certainly a big time macro tourist. I felt like I understood macro and was aware of it, but certainly did not have the data driven component, or kind of like the lack of being able to kind of just take the emotion or the human element, as you mentioned a few minutes ago, kind of taking that piece out of the equation. And that's been a huge shift. And so curious how that's impacted both your personal, like your PA, as well as sort of, how you're taking that approach to your client accounts as well.
Mm-hmm. Yeah, I'd say, speaking towards the PA first, I've really appreciated, I think, the real-time alerts. Whatever the alert is, I care less about that, but I care more about the timing, the market environments that are, triggering these alerts.
Big time.
What I've found, very candidly, is that for the macro thing, so gold, bonds, S&P 500, NASDAQ 100, Keith's timing, or Keith's models, have been very, telling of very short-term indicators and things of that nature. And I think that there's a lot of value add if you are in your personal account, adding or reducing risk based on these signals. I would say and this was so prevalent, oh my gosh, at the start of 2020, because this was when, I, not at my current place, but I actually looked at this with some, computer software people at my previous firm, where we actually looked at the signal, like how profitable is it, the Keith signal, the RTAs, and we we found there was a lot of noise in it up until the start of 2020. And I think a lot of that has to do with just retail trading. Ever since Schwab, who I think was a first back in end of 2019, decided to cut commissions down to nothing, basically, and Ameritrade and everyone else followed suit, you started seeing a lot more retail volume. You started seeing the trade work better. So by the time the first and second quarter of 2020 came around, when everyone's at home and everyone's, whipping and driving their PA at Robinhood or Interactive Brokers or wherever, the signal on RTAs went through the roof. Like, it was true alpha, and alpha in the sense, very crudely speaking, that there's going to be buyers coming, and if you can buy it before other people, then sell it. That's what we looked at. Like, at my previous place, it was very much short-term, event-driven stuff. You have CNBC, 5 seconds. Your feed to CNBC is a little bit faster than the broad public or Bloomberg or whoever. If David Faber comes on and says, someone is going activist on whatever company, you can wait. Like, there's a few seconds, if that, and it's always getting more competitive and goes away. And that was a case here too.
Interesting.
Hedgeye came out with their app. They leveled the playing field. It was, kind of like Flash Boys, where there's a lag in order, so now it hits the exchange at the same time. So that went away. But that was, going back to that point of retail trading really growing, and that was really apparent with the Hedgeye RTAs. So that's a completely separate thing. But as I speak towards, and I have no idea if that still is something that's done or not. I can't imagine there's much, if any, money to be made there. But as it relates to the macro views and the decision making there, I have found it to be incredibly good, to the point where I would honestly just rely on that for deciding when you're dialing up and dialing down risk. And again, like my previous role, leave your emotions, leave your biases, leave, oh, I
Yeah.
think it can go higher or I think it can go lower at the door. Because if there's a better way to do it that doesn't involve you, it's probably a more sustainable way to go about things.
Yeah, yeah, it's certainly, and especially longer term, right?
Mhm.
Yeah, no, that makes sense. That makes sense. So then, how have you found, like in the last kind of 2 years, either your incorporation of the tools? I know you said primarily kind of macro show certainly, is a staple and what have you, but how have you either leveraged more hedge tools or incorporated some of their data driven process into other elements of, again, you've talked about back testing, RTAs and things like that. So curious about sort of what other, if there are any other tools that you currently leverage that, and how, Hedge has helped sort of improve or expand the success of those.
Yeah, I think like at the crux of it, when I think of Hedgeye, when I think of the value add, for me at least, as an asset allocator for sure, and just in a general investor, the quad maps and just seeing the sequence of quarters and what quads you're in, that is 80 to 90% of the value for me, because I can see, okay, the US is in quad 4 and it looks like we're going to be in quad 4 for a while. Like it's always so hard. Like the way I look at it, and the reason why I think good investors tend to have no idea or just doubt themselves all the time is because it is so hard. You can, when I think of like, okay, we're in a quad 4 environment, to me it doesn't mean that it's so, this is easy, this is so obvious, let me just put on these consumer staples, let me short some high beta things, etc. It's still going to be super confusing. You're still going to look at your positions and say, oh my gosh, like, is this going to work? Is this right? This is what the data says, but I'm not seeing it play out. But over time, it does play out. If you're right on your macro, things should play out and you should see, a respectable rate of return. But it never feels like that at the moment. So I think like it's good to just, be able to look and take a holistic view of what's going on in the world. Yes, maybe today things are down, maybe tomorrow things are up, but over time, you should see the market, tell you you're right or you're wrong, but you just kind of have to deal with the fluctuations in between. So if you look at it from like a distribution curve, a normal distribution curve, you probably have half of the outcomes are going to be up, half of the outcomes are going to be down. If I'm investing in quad 4 assets in quad 4, I expect a slight, I think that the deck is going to be hot, so to speak. So like if you think of like blackjack, you might have a slight edge. So instead of having 50% of the outcomes be down and 50% of the outcomes be up, maybe it's like 53 or 54% are in your favor and the remainder is against you. But there's still downside risk. It's just, you want to have your bets out, which is why like, and this is to a point as well, like I don't think that one should be having all of their, bets in the same thing. Like you could really like Apple or you could really like tech. And if this was a time to own that, just own that one individual thing is not a good way to go about this.
Yeah.
It really amplifies your upside and downside risk. And as we know, if you lose half of your money, you need 100% return to make it back. So, being able to find a higher number of bets, increase the diversification of your assets. And ideally, all of these assets that you are looking at do perform well in quad 4, and as we're speaking towards right now. So utilities and staples, those are the big two that come to mind, but also dividend growth and more defensive type equities. Then you can layer in some gold and some duration and all of these other things. All of a sudden, you've got a quad 4 portfolio. And while you're still going to be exposed to the market going up and down, you should, over time, start seeing a performance difference between you and the market and you and everyone else.
Now, do you incorporate international as well, Dibsey?
Yeah, so that's a great point too. I think international. So I'll say this: international,
and I refer to that literally like in terms like outside of domestic US, right? So whether it be Europe or EM or wherever, right? But
and I really enjoy the quad map because the sequential, it shows all the countries, it shows all the quarters and where they are or where they're going, and they do that internationally too, which is great. I mean, the fact of the matter is the US is not the only market. It's been an awesome place to invest for the last 10 years, for sure. Thank you, Mega Cap Tech, for that.
Yeah, exactly.
But there's so much more in the world. And I think, I know people, I've heard people say this back in 2016, back in 2018. No, this is a year international is going to work. We'll see what happens this year. But I actually favor international markets over US, mainly because we're in Quad 4 and not all of international is. There are pockets, Indonesia, China, by mid-year, looks like they're going to start accelerating again. So there's other things that you can do. And I think as a diversified investor, you kind of have to. It's good to have the US budget, but you kind of have to want to look elsewhere too, to make sure that you are, doing the best job you can to be diverse.
Yeah, I 100% agree. And I think, certainly year to date right now, I mean, core ones like a Thailand or Indonesia, right, which are two that I know Hedging and Keith certainly have enjoyed year to date. I mean, they've been great performers, right? Or especially in comparison to, the SP 500 or, let alone the NASDAQ and the Russell, right? So
and that's an interesting point too. Like a lot, and this is something that we've studied. We study a lot of different things at work, active management in the US, active management in international small caps, et cetera. The biggest difference between why the US market, the S&P 500 has crushed it for so many years versus, how the MSCI ACWI ex-US, so just looking at the rest of the international market, has done. The biggest difference is just Silicon Valley. It's the large cap, mega cap tech that is accounting for all of the alpha, quote unquote, that we've seen in the US markets that we haven't seen internationally. And, we have, I'd have to look at what the risk ranges are saying right now, which I also really respect and enjoy. But a lot of those mega cap tech names are not bullish trend right now. And if you don't have, these companies, which are amazing companies for sure. I mean, the S&P 500 has the top 500 for companies in the US, basically. But if you don't have, these huge portions of them, and now we're looking at things on a relative basis, that's why I would say international is probably going to be performing better. On top of, Quad 4 here, and maybe not Quad 4 completely, outside the US, you also have all of the, largest weights of Google, Microsoft, et cetera, being in a bearish trend. So just from a relative basis, this bearishness is not really existing in international markets. That's another reason to say, okay, international, this might be their year.
Yeah. And Chris and I talked about this last week a bit too, just in terms of like the UK, right? And like the Footsie and how it's got like kind of, it's got a bit of a heavier weight to energy or sort of, oil related equities, as well as, dividend, growing, basically, dividend stocks, right? So it's in a general Quad 4 environment, that, again, and in this particular one, because they're all different, but where oil is, or at least had been up at, $90 a barrel or what have you, and kind of still late cycle inflation, those are all there, the Footsie is being benefited versus like the DAX, right? Which is a bit more kind of, manufacturing and sort of consumer centric, right? In terms of like the longer term output of goods. And so if the consumer is being impacted, right, like the DAX won't perform as well, but then you get, dividend growth, dividend stocks and that kind of thing in the Footsie, and having a better understanding of a number of those underlying components inside of each exchange can be very helpful, right? In terms of like, okay, again, not necessarily needing to know the narrative per se, Dibsey, right? Which I think you and I both very firmly agree that, narratives are narratives and they come and go, but it's more about kind of just understanding a bit more like what I would call the mechanics, right? And sort of like, okay, again, I'll just keep harping on the Footsie. The Footsie is outperforming relative to other European asset classes, and kind of why is that? Oh, well, it's got, X percentage inside of kind of like energy related equities. And therefore, you just have to be cognizant about that, because if oil or, quote unquote inflation relate, inflation commodity exposure starts to continue to kind of deflate or decrease more exponentially, then you're going to have to keep that Footsie on a shorter leash. But in the interim, it's been a pretty good place to have your capital.
No, I would definitely agree with that. Just
Yeah.
being able to look at things, and it sometimes it's not even like what the absolute return is up or down, but it's how does this do relative to what's out there.
Correct.
Everything is down today, but you see utilities and consumer staples are down less. That's just to me, that's a quad 4-day. Okay, this is the environment. This is telling me, okay, I think I'm on the right track.
And it's still outperformance, right? I mean, it might be, it might be a negative day, but but you're still outperforming. And I think that's a really good point, and one that probably you deal with more frequently than say I do. I mean, I manage my, basically my family's, like as in my wife and my kind of retirement accounts and our, taxable account, et cetera, et cetera. So, I'm always, obviously I'm looking to kind of compound and grow my capital. So again, a down day is not great, but obviously an outperforming down day when you're still generating alpha still feels awesome. So I can only imagine that, when you are having, but I can also be, I have control over my cash position, right, Dibsey? So like, even though, if I just don't want to have to manage this, or, this week in particular, right, I'm on holiday with the kids, and it's like, it's okay for me. I'm very happy being in 70% cash, right? Because it's like, okay, I just don't want to deal with the volatility and until I can get back in my seat. But when you do have that, when you're managing, money for, high net worth individuals, I can only imagine you are, well, when you kind of not always have to be invested, but you kind of have, you probably only have such a time frame, or kind of as there's a certain amount of rope, right, that they'll give you in terms of like, okay, like, it's cool to be in 50% cash or whatever for like a couple of weeks, but like, okay, it's been like 3 months, Dibsy, like what's going on, right? so
Well, yeah, and on top of that, it just gets complicated with taxes.
Sure.
Right? Like it's a very fine line or art, if you will, between raising cash to be defensive, to be thoughtful, and if it's like a 3 to 6 month worry, you could sell and realize gains, and you need to pay taxes on that, which is totally fine. I'm not saying it's not, but over the long term, that detracts from the long term performance that you would have. So I would say, like, on the personal level, it's awesome that you can be so flexible with your investing. I'm the exact same way, where majority of the time I'm basically all cash unless there's good opportunity, and then I'll say, okay, let's dial up the risk and let it go, basically. It's not like that. So it's very unrealistic to assume that you can be buying and selling to that degree and creating all of these gains and losses, because at the end of the day, the two things that I think are true alpha in the world are having time on your side and having a budget for illiquidity. So by that, I mean, if you invest over the long term, you're probably going to make a rate of return. There's going to be times when you're down, but over the long term, you're going to make a rate of return. And with illiquidity, if you don't need the capital for the next 5, the next 10 years, you are able to participate in deals where other people might not be able to. And the market's going to price that right for what the risk is. If you're able to like tap into your budget for liquidity, whether that's in private credit, whether that's in private equity, whatever it is, there is opportunity for excess return, for alpha, if you will. But there's a trade-off, because you can't touch that money really for a while. So it's a fine balancing act. Just looking at where there is opportunity to be taking these types of investments.
Yeah. And so then how do you, I mean, that's a great segue actually. So like, how do you guys, or how do you personally think about what kind of like alternatives, right? And sort of, either for your own, in your own account, or, inside the family office. And because again, I mean, that kind of thing is, for example, private equity, for instance, right? And it's tied up for anywhere from 5 to 10 years, right? I'm just using general bands, but, and, you're kind of got a bit of a, you're incorporating sort of like the hedge process, right? In terms of like the data driven, okay, we got quads, et cetera, et cetera. Obviously, that again, like this is probably, so this could be a good time to really like kind of ramp up some of that PE exposure, because they can get, again, if tech does kind of get crushed here in the next few months, you're going to get like much better multiples and valuations than you would for the same companies, if they were, doing a series A or B, C, whatever it is, this time last year, right? Those multiples would have been probably, at least 2x where they are today.
Very high.
Very high, right? So yes, I mean, now that I'm actually talking through this question, I'm realizing that it probably is a good time to, to basically allocate towards some PE or alternatives. But I'll pass the question off to you, Dibsey, and see how you guys incorporate it, because yeah.
No, Rob, I think you hit the nail on the head. Valuation. This is so interesting. Just seeing what's happening in the market right now, and making the analogy of this is like the .com burst and whatnot. And now the NASDAQ of the 2000s is more like the S&P 500 now. I'm sorry, I have that wrong. The NASDAQ of today is more like what the S&P 500 was back in the 2000s. But now you have ARK, for example, with these high flying, super high valuation, super high growth, very little profitability companies. That's more representative just thematically of what the NASDAQ was back in the 2000s. And so it's really fascinating to just look at where we've been within the valuations of tech and high growth. And I think it's so fascinating as we go back to, comparing how things perform relatively. I'm out every day, I'm looking at how is the NASDAQ 100 doing versus how is ARK doing. And there's more days than I'd like to admit where I'm just scratching my head and wondering if rates are where they are and inflation is where it is. And ARK is only down 30% or 40, whatever the percent is now. I'm just a little dumbfounded by it. That's of course a separate topic in the matter, but going back to alternatives and that space, private equity, private credit, I'm really constructive on it. I think a lot of this comes from equity markets not looking great, bond markets not looking great. What do? You can't be in cash because you're going to lose your purchasing power via inflation. But you can go to alternatives. You can go to a low correlated asset where you're not going to hit it out of the park by any means, but you're going to provide another return stream for your portfolio that has lower correlation at a time when both equity and bonds are kind of moving in tandem, or at least are having elevated levels of correlation. Yeah. So to me, like from a portfolio construction standpoint, yeah, I really think alternatives is a great place to be. Not investment advice, of course.
No, yeah.
But like just thinking about it, given where we are in the world and all of that, it kind of just seems like a no-brainer to me that's where the opportunity is right now.
Yeah, I've been doing, on the personal side, again, I don't have enough net worth to really, qualify for, some traditional kind of PE funds, but there's so many now alternatives too, Dibsey, like, even just, like real estate credit, right? There's a company called Fundrise or Yield Street, I believe is another one. And there's a number of even seed invest, right? If you wanted to get into early, this is not investment advice, but just certainly things that I've been thinking about the last few weeks. About sort of, okay, like if I'm 70% cash in my taxable account and I'm not really seeing great opportunities inside of the equity space for the next couple months, then, how can I go, put that to better use, right? In terms of, again, doesn't necessarily need to be these alternative streams. It's just, what can I do with that? And, one main thing that, again, kind of one of the reasons why I was speaking about international and like the Footsies, because, going outside the US, I'm kind of getting back to like the roots, right? Or I'd been quite heavily focused on the US, basically for the last 2 months. And you and I talk about the US market a lot on a daily basis. But it's really, again, it's like, you don't have to crush it, right? You don't, Thailand, even if Thailand only, gives you 3-4%, whatever, it's a 3-4% that you weren't getting just sitting in cash, right? So that to me, that's phase one, is kind of reevaluating, getting back to like the crux of the macro environment and being able to go anywhere, that go anywhere strategy. But then secondly, especially after this conversation, I'm going to be looking more into those alternatives, because again, valuations are better. And again, if we're in sort of a quad 4 to maybe a quad 3 to quad 4 again, right? Then you're looking at almost like an entire year of 2022 where equity volatility is going to be certainly likely in the chop bucket, if not if not higher, and you may need to have some other exposures elsewhere in order to going back to your commentary about just having even just some returns, right? So like your time is on our side as a young man myself and a young family. So having that, just being invested in some capacity certainly is beneficial.
Definitely. And to that point also, like on alternatives, there are mutual funds that are very well run strategies from BlackRock or other providers. Not an endorsement or anything of that nature, but they do have stuff out there to all their own for doing their own research, et cetera. But like it's not the case where I need $1 million to even get a look at this. You can do that with a fraction of it.
Right.
And it's good quality stuff, frankly speaking.
Yeah.
I think that
do you guys use a combination or hybrid of that kind of?
I think it depends. And that's kind of getting into the nitty gritty of how we structure it.
We don't need it. Yeah, we don't need to do that.
No, I'm happy to speak towards it because I think it's interesting and I think it's powerful and one of the value adds. I think the world of wealth management in general kind of get a bad rap because there are the people out there who are salespeople and they're wearing an investment hat basically. But I would say, one of the unique things that we do, and I'm sure a lot of other, firms are able to do, is, kind of pool client capital. And so we can access these larger, private equity or alternative managers as one ticket. But then on our side, we're going to be doing the back office work to allocate to our clients. So you can come in with $200,000 for an investment that has a minimum of $5 million, basically.
Right.
Because we're, pulling together and we're able to get to that $5 million ticket, which is great, which is exciting as it relates to, are we using these mutual funds for alternatives exposure? It depends on the structure, depends on the asset class, but within alternatives, there's what's called like drawdown funds. So you might commit to $10 million for something. And over the next 3 years, you're probably expecting them to call it down. So, hey, Dibsey, we need $800,000. 6 months later, we need $2 million, so on and so forth. So make these commitments. And so that's another element now of managing those funds, of making sure that we just have the liquidity, frankly, to fund these commitments. Money might be coming in one door, it's going out the other door to fund something else. So that's, something that makes liquidity management important for us. So these liquid alternatives is how I'll coin them. You get NAVs, you can buy or sell them to raise cash or put cash to work. They serve as a really good buffer in terms of cash management, because we don't want to just own or have cash in this fund because that's going to be performance. We can put it in these liquid alternatives so we continue to get the exposure that we want. And it can help fund future capital calls, or if clients need to redeem any capital, can fund that too. And then because we have that taken care of, we can then go out, in terms of the illiquidity spectrum and go, put our money somewhere where we probably won't see it for a couple of years, but the returns are, compelling. So we're getting compensated for that.
That's awesome. Yeah, no, a good hybrid model, right? Of sort of low column A, low column B. That's great.
Yep.
So, and again, I want to be respectful of your time. So thank you again for joining me today. Do you have kind of one sort of last question, maybe question and a half, just in terms of sort of, I guess, evolution, right? Or where are you today versus like when you began? Again, obviously you come from an investment background, you're a very savvy individual. So the hedge process wasn't that kind of unusual for you, but I guess curious in terms of, what has been, I guess, amplified maybe is what has been amplified by the Hedging process, and then sort of, what have you tacked on top of the Hedging to like really, perhaps get even, either better returns for yourself or just internally kind of within the family office. So, and again, if you just want to keep it focused on your own PA, that's fine too. Whatever you need to do.
I'd say the very high level for it through the macro show, through the quads, through that risk management process. Well, I'd say more through the macro framework. That I think is where I've grown the most. Where before I was looking at things from a very short, in my previous role, I was looking at things from a very short term, stock driven focus. There's opportunity here. JP Morgan upgraded Delta Airlines,
right?
Jimmy Baker thinks it's going to $60 and it's 52 right now, and it's up 0.5% since the report came out. And what do I think that it's worth now that this report is out? 53, 54. Okay, buy the stock.
Right.
And it's a completely different game where with Keith's model, with the macro framework, you're not looking at these day-to-day things. You're looking at the big picture. And I think that just using that framework and just getting used to it and thinking about things in that manner really helped me become a better macro investor, which is great because for my job, I'm an allocator of capital. So we're, on sometimes, depending on how clients want to be interacted with, they might want, specific stocks. They might want specific securities. Other times, they prefer that we allocate to a manager. And so we're, underwriting the manager to make sure that, we think that the process is consistent, it's repeatable, there's edge, there's something that makes us want to be with them as opposed to, someone else or a passive product.
Sure.
And I think through this macro framework, it really just helps me think about, the world and these investing opportunities. So, an area that we look at right now with conviction on the US side is dividend growth.
Okay.
I wouldn't have thought that dividend growth, let's go check this place out. Let's go see what's going on there. But when thinking about coming into a quad 4 environment, we ran, and I know I spoke about this a couple of weeks ago on the notebook review that you host on Wednesdays, which is always a lot of fun to join. We looked at the back tests on previous quad 4 regimes. We looked at how consumer staples did. We looked how utilities did. We looked at, every factor, every style, every sector, that has good data. And our conclusion was, consumer staples is pretty good. Utilities is pretty good. These are sectors though. So that's sector exposure. I don't know if that's, super applicable for work. Let's look at the styles. And the one that, just performed, it doesn't even have to be the best, but the most consistently outperformed was dividend growth. And so that kind of led our efforts to begin looking more into the space, looking at managers, looking at passive options, and really dialing into, what do we do with this insight, which, came because we realized, or we saw that we were heading to quad 4. We looked at what works well in quad 4 and what's applicable for us. And then all of a sudden, we're now looking at the dividend growth space. So I think that's a great example of how these macro, things that we're hearing or viewing or reading or researching through Hedging can translate to actionable, things that can help portfolios. And I'm sure if you just pulled up a dividend growth ETF for the year, I'd imagine it's doing better than the S&P 500, but for sure doing better than the Russell 2000 or the NASDAQ 100.
Yeah. No, I know there's one particular, I'm not currently invested in it, but SPHD, which is an Invesco one. So it's basically a low vol, high div. And I know that one's been a big outperformer last, certainly year to date and on a relative basis, right? I can't remember if it's actually, probably green on the year, but it's certainly outperforming its underlying index, right? And it's been, so just the divvy exposure in general has been a great factor analysis or factor to have exposure to. That's great, Dibsey. Any other thing on top of your head, I guess, to wrap it up, or anything else that you
I think
sharing
that we
today?
covered.
This was a great, we covered a lot of different subjects, so I thought that was pretty darn good.
Yeah, no, I completely echo that, Robert. I think we touched on some very good things. I guess for the listeners, I'd always, say tune in on Wednesdays also for the notebook reviews because they're a lot of fun. Whether
They
the
are.
markets are discussed or just talking about things, it's a very open, welcoming community for people to talk from different backgrounds, and I think through that, it's good perspective, and I think we become better.
Yeah, I appreciate that. That's very kind of you to say, and I would agree. It's really interesting having, and again, it's kind of another thing that spearheaded this kind of podcast or vlog, whatever you want to say. And it's kind of getting the different viewpoints and the data out of Hedging and how it gets applied to their investment approach, right? So whether it's an average investor, right, like myself, who has a day job, who's doing this kind of, on the side, or if it's somebody who's traded the markets, basically as their job, right, or a retired individual, whatever it might be. Then it goes to the other spectrum of, yourself and many other, not only family offices but RIAs and that kind of thing as well. So a lot of professionals is, leveraging the Hedging tools and that kind of thing. So it's a wonderful, it's been a lot of fun to speak sort of like across the gamut. And so Dibsey, I look forward to another conversation with you soon. And you always got awesome commentary on the Wednesday notebook reviews. So thank you for those as well. And with that, I think we'll kind of wrap things up. So look forward to the next week. So another episode will come out next Friday. We're narrowing down a couple other guest speakers and that kind of thing, but hope everyone's surviving the at this point Digi's going to come out on Friday, right? So we're Tuesday. Hopefully, either Russia will or will not invade the Ukraine. Oil will or will not go up. We'll see what happens, right, Dibsey? All the best. Thank you again for your time today, and we'll talk soon.
Great. Thanks, Robert.
Cheers.